stocks this week, a mixed week for the markets as the rupee broke 60 to a dollar. We'll find out what your investment strategy should be now. Oil and gas stocks rally after the government approved a gas price hike. We'll tell you what this means for your stocks. And HUL's open offer closes next week. We'll find out if you should be taking it and what the tax implications of your decision will be. Welcome to All About Stocks. Thank you so much for joining us. Now, this is a show specifically meant for long-term retail investors who invest their money in the stock market. And what a week we've had at the market. I'm going to put the Sensex up on your screen for this week, and you'll see that we were painfully low for the first half of the week. The rupee hit 60 to a dollar, and when we thought there was no hope at all, the government increased the prices of gas, and then the market and the rupee recovered. Now, what this means for you and me as retail investors is that it's a very, very difficult market to read. It's a difficult market to predict. So how do we plan out our investment portfolio in a market like this? That is what we're focusing on this week. We also take a very close look at the oil and gas sector and find out the best stocks for you. We'll, of course, answer some of your questions and design portfolios for you. There's an email ID at the bottom of your screen where you can send in any questions you have. My colleague Ajay is, of course, here to update us on the markets and the rupee and take us through what happened. Ajay.
Well, so it was a roller coaster ride for global equities this week, and India also participated in it. We also saw the big trigger coming in from the US market, where the first quarter GDP data was much lower than what the street was estimating, and hence triggered a rally because weak data weakens the case of withdrawal of QE, which has been spooking the markets for some time now. The People's Bank of China also came out and eased concerns regarding the much talked about credit crunch which is going on in China, also helped the sentiment. And then back home in the Indian markets, there was a huge short covering rally which started on Thursday, which was the expiry of the June series. And since then, there was almost no looking back. We added almost 300 points on the Nifty in the last 2-3 days alone. Of course, the big decision on the gas prices is also adding a lot of positive to the sentiment in the market, given the fact that the government is still sticking on to the reform commitment as far as the Indian economy is concerned. We saw rupee also made an all-time low versus the dollar, almost to the 61 mark, and recover equally sharply by the end of the week. Traders believe that rupee's volatility will be something to watch out for and will be determinant on the market direction, apart from the global cues, which have actually turned favorable past couple of days.
All right, Ajay, thank you so much for that information. Joining us right now, Gaurang Shah, Assistant Vice President at Juliet BNP Paribas. Gaurang, thank you so much for joining us on All About Stocks. It's been a really tough week, a volatile week. A market like this is very difficult for a retail investor to read, and it's normally also something that causes great amounts of nervousness among retail investors. Explain to us what's going on and what should be our approach to a market like this?
Well, I think firstly, let me inform your viewers through your channel that, normally it's always a case wherein whenever the market is going up, you will have a lot of people running into the market and wanting to buy themes, sectorially, stock-specific ideas. And the flip side, when the market is falling, the same investors you will see running away from it. Well, my idea is a little bit different. And if you're not looking at the near-term problems, of course, we have issues to deal with. At a correction of 10 to 15% on the Sensex and Nifty index-wise, sectorally maybe a little bit more, I think this is a perfect time to go and buy stock-specific ideas. You need to be a little bit careful. You should concentrate on themes which are going to play out going forward. But my belief is that if you're getting something at a correction of 10 to 15%, your profit margin increases in case if you have a long-term horizon and if you pick up the right sectors and right stocks. So first of all, the advice is avoid company names which are having high foreign currency debt repayment obligation in the next 3 to 6 months. Avoid names where the promoters have pledged their shares. Avoid names where you've seen a very sharp correction in a very short span of time. Just because from 3 digits to 2 digits and 2 digits to 1 digit if the stock is available does not excite you to go and buy. I think you should all the more avoid these kind of stocks. And you should be more disciplined. In these kind of correction, I am nowhere advising that you should put 100% strength of whatever investable amount you have. You should be a little bit more disciplined, 20, 25, 30% depending upon your risk appetite. You should definitely go and deploy. And maybe on further correction of 5 or 10% if you get any, you definitely have more funds to go ahead and deploy. So my view is that these corrections should be rather seen as a buying opportunity rather than looking at it as a running up opportunity.
Gaurang, we have to talk about the rupee. It hit 60 to $1 this week, and it did seem like there was no hope in sight. Now tell us, as far as the IT sector is concerned, it was one particular sector that we knew would profit from a weaker rupee. But now we've seen the fact that the US government has passed that immigration bill that will hurt the sector. Are you bullish on the IT sector at all? Do you see any value there?
Well, I think the immigration bill getting passed is definitely bad news for the IT sector, Indian IT sector. But my view is that it will not have a huge negative impact. It will possibly evolve over a period of time. And even if I have to look at minus US, the kind of efforts some of the Indian IT companies have put into place, considering that these bill will possibly come through, they have started concentrating on other geographies, other locations across the globe to make good of the negativities arising out of this bill which is passed in the United States of America. So yes, there are still on the fundamental side some companies which will definitely go ahead and deliver much more better numbers. But if you want to avoid IT because of this particular episode which has evolved in terms of immigration bills passing through, pharma is the place where I would see that there is a strong tailwind in form of currency fluctuation. Most of the pharma companies have exports in the US market, European markets, dollar terms revenues are booked. And of course, in terms of performance quarter on quarter, last 3-4 quarters, some of the pharma companies, especially in the mid-cap category, have done phenomenally well. So my idea is that if you are a little bit risk averse, if you are looking at rupee-dollar equation and wanting to play that out via investment into the equity markets, then I think pharma sector is the best suited. And over there, names like Sun Pharma, Lupin, Dr. Reddy's, Divi's Laboratories, Cipla, Glenmark. I think some of the names you should definitely go ahead and look at buying. Humble request over here, avoid names like Ranbaxy because this particular stock has seen a sell-off, a huge carnage in investors' wealth. And I think there should be more downside.
The other sector we must talk about is the oil and gas sector. In fact, Syed has written in, he has a question for you. 228 shares of ONGC, which he bought at 281 rupees. He wants to know if he should hold on to that stock. ONGC ended the week at 331. Now, the big news of the week was the government's decision to nearly double the price of domestic gas from April next year. ONGC stands to increase its profit by $1.3 billion. Of course, there are other stocks that will profit from this, RIL, Oil India to name a few. What I'm going to do is I'm going to bring in Ajay, who's been studying this decision by the government and the impact on various stocks very carefully. Ajay, take us through each of these stocks and how it's likely for them to be impacted.
Well, Faith, this was the big policy decision which was taken by the government this week. Almost after a gap of 3 years, the natural gas prices are being revised in our country. A decision has been taken to hike the gas prices from $4.2 a unit to $8.5 a unit. However, this new pricing will be applicable from 1st of April 2014. It will not have any cap and the prices will be reviewed every 3 months. The two stocks or two companies which are direct beneficiaries of this decision would be ONGC, which is the largest state-run oil and gas company and currently produces maximum amount of gas in our country. Analysts see that FY15, when the full impact of this decision would be coming, the earnings of this company could be jumping by almost 30-35%. We did see a fair share of volatile movement in the stock price also. However, one portion of the analysts on the street are raising some questions on whether the government will go ahead and hike the subsidy burden which the upstream companies bear. CLSA says that Reliance Industries, which is the other beneficiary of this big decision, is the neatest play of this decision. And 2016 and 17, when the production of KG-D6 is expected to gain, then the earnings of Reliance could see the maximum amount of delta. They are indicating at 14 to 15% increase in the earnings per share of Reliance Industries going forward. However, Macquarie says that the overall E&P segment of Reliance Industries will go through a transformation in the next 1 or 2 years, mainly led by this decision.
All right, Ajay, thank you for that information. Gaurang, ONGC bought at 281. Ajay, they're telling us it's a possibility that a subsidy burden might not allow ONGC to completely enjoy all of that increased profit. What's your call on ONGC right now?
So as a disclosure, we have a positive coverage and our target stands at about 365. This target is with a view of about 12 to 16 months. And I think the gas price revision, like you rightly mentioned, will be in effect from 1st April 2014. And on the flip side, if I go to see, the government is making all its efforts to reduce the subsidy burden. And my guess is that going forward, there will be many more efforts taken by the government to reduce that burden. So quite optimistic, and given the fact that it is one of the largest players in this particular sector, I would recommend a hold with a target of 365.
All right, hold on. GCB, of course, have questions on RIL as well. Mahesh Kumar has written in. He has 1,000 shares of RIL bought at 812 rupees. Should he hold on to that stock? RIL, of course, ended the week at 863. It ran up quite a bit after that piece of information came out. Gaurang, what's your call on RIL?
A huge positive for private players, this particular step that the government has taken in terms of revising the gas prices. Not as much for the PSU. But yes, talking about RIL, as a disclosure again, we have a positive coverage. Our target earlier when we worked out, before this news came in about gas price revision, was somewhere close to about 870. And the CMP was somewhere close to about 850. So we will definitely revise the target upwards. Huge positive, and I think there should be an incremental upgrade in the EPS coming anywhere between 8 to 10 basis points. This should also give an incentive for RIL to ramp up production in the KG-D6 basin, which as of now, as we speak, is at its historical low levels. So it is a good move, and my guess is that any positive news on production ramp up will definitely make the stock being re-rated at much more higher levels. So again, hold on over here. Initial targets are 870 as what we are working with, but with this positive news, I think you could possibly look at 940 to 960.
All right, so hold on to RIL. Now it's time for us to move on to our portfolio segment. Every week we take a look at the portfolio of one lucky viewer. Today we're looking at Sukhjit's portfolio. He has the following shares, Gaurang. He's not doing too well on this portfolio. He wants you to help him decide which of these he should hold on to and which he should sell. 70 shares of Dish TV bought at 68 rupees and 20 paise. Hold on to that stock?
Definitely hold on. Positive on the digitization, and of course one of the largest players. We are looking at a target of 85. And the stock is somewhere close to about 60. So any day if you get a bad day and the stock is available at below 60 levels, my advice would be to definitely average in case if he has investable amount.
We also have 200 shares of Manappuram Finance, which he bought at 17 rupees and 70 paise. That stock ended the week at about 10 rupees. Gold prices are fairly low right now. It's at a 3-year low, in fact, on Thursday. Now, this drastically affects the valuation of the company and the way they hand out those loans. What's your call right now on Manappuram Finance?
Well, lower gold prices are definitely good news and music to ears of yours and mine, because it will definitely make us go and buy more gold in case if we've not bought any. So for gold investors who are looking at buying gold, it's good news, but investors who are stuck in gold loan companies, I think it's bad news. My advice over here is that before any further damage can happen to your capital, sell out from the investment that you have over here, and look at buying something like BCD, available about 45 rupees. With a 12 to 16 months time horizon, we are looking at a target of about 65, if I'm not mistaken. And again, don't trend to average, either of these gold loan companies in form of Muthoot or Manappuram just because they are available at huge discount than what they were quoted about a couple of months back. You could possibly end up damaging your capital altogether.
All right, time for one last stock, 100 shares of Orbit Corporation, which he bought at 25.35. That stock ended the week at 16 rupees, Gaurang. He's making a bit of a loss there. What should he do with that stock?
Any further damage, go and sell the stock maybe next week, Monday morning. Look at buying IDFC, tailwind again over here in form of news of banking license. We are looking at a target of about 185. Stock is, I think, currently trading at somewhere close to about 125 to 130, somewhere around that. So there is an opportunity to go and buy that stock, but Orbit definitely a sell.
All right, Sukhjit, we hope that helps. Now, if you're sitting at home wondering how to put together a portfolio just like Sukhjit, well, Gaurang has designed a portfolio for us. He's put together stocks that he thinks make sense for you and me as retail investors. When we come back after this break, we'll take a look at that portfolio and we'll look at how it's done. Don't go anywhere. welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. Gaurang Shah is helping us with our stock investments right now. For those of you who watch this show on a regular basis, you know Gaurang designed a portfolio for us on the 14th of December last year. Now, we've been tracking this portfolio very carefully to see how it's done. Now, it's currently at a loss, which is not surprising given where the market is. A total loss of 1.30%, almost 1.29%. Compare that to the Nifty. The Nifty is down 0.63% at the same time, which means it's moving largely on par with the broader market. I'm going to give you a list of the stocks that Gaurang has picked for us. There's IndusInd Bank, Cipla, Godrej Consumer, Tata Steel, M&M, ACC, Mindtree, Apollo Hospitals, IRB Infra, Kane India. And these are the stocks he's picked for us. 10% in each of those stocks. They're 10 stocks, equally divided. Gaurang, a couple of the mid-caps that have done really well. Mindtree and Apollo Hospital have actually given you good returns. Tata Steel is a big disappointment. It's down about 30% since we bought it. What do you want to do with that stock?
Well, unfortunate over here, and one does not need to get sentiment as far as their stock investments are concerned. And of course, you have to take remedial action and steps at an appropriate time. And there have been time and again when a number of times on your channel itself I have mentioned that investors should book losses. They should not only look at booking profits. So here I would definitely want to exit Tata Steel and make a switch over here. I would want to bite the bullet. At times you have to do that and take certain steps which would possibly hurt you in the short term, but for the long term it is always beneficial to do something like that. So I'm going to exit Tata Steel at a loss of 30% or so, whatever I'm taking a hit. And I'm making a switch off from Tata Steel to Havells India at current levels. And I'm looking at the target about 830 with at least 12 to 16 months time horizon. And I'm thinking in terms of, the consumption theme, with the kind of presence that Havells has, product profile, etc., market share, I believe that this should make good of whatever losses I'm making in Tata Steel.
All right, I also want to ask you about IRB Infra. If you are concerned about Tata Steel being down 30% since we bought it, so is IRB Infra. What makes you confident about this company?
Well, if I look at, I'll put in perspective. Metals domestically and globally are doing well, and I think it's going to take a long, long while before the entire metals pack, both on domestic and on the international front, the orders start picking up. Prices of flat and long products are absolutely down, and I don't think they'll move upwards. So my view is that steel will definitely tend to underperform. On the flip side, yes, I'm taking a beating on IRB Infra, but I'm quite optimistic that if the government is talking about powering up the GDP growth and improve the view of global investors, which they have as of now for India, one thing they need to do is to fire up the investment in infrastructure. IRB Infra is present into highways, expressways, and a lot of other infrastructure projects that they have underway. Stock has corrected quite sharply in the recent times, rightly so, because the entire infrastructure pack has done bad. But I'm optimistic that this particular company will definitely stand tall in terms of government taking initiatives to reduce the bottlenecks as far as the last mile coverage is concerned for infrastructure projects, and of course giving some kind of incentive and boost to this particular sector. That is when I feel IRB Infra will definitely start outperforming.
All right, a quick recap on Gaurang's portfolio for those of you who are writing it down. IndusInd Bank, Cipla, Godrej Consumer Products, Havells, M&M, ACC, Mindtree, Apollo Hospitals, IRB Infra, and Kane India. Now, of course, every time Gaurang is back in the studio, which is every few weeks, we will take a look at that portfolio again. Gaurang, we have a question from Narendra, who's written in 400 shares of Bharti Airtel, which he bought at 323 rupees. Should he hold on to that stock? Bharti ended the week at 291. Now, we know it's cutting the base plan package for its 4G services by nearly 30%. It's also in trouble with the DoT again. For all of our viewers who are holding Bharti Airtel right now, what's your call on that stock?
Firstly, a disclosure, positive coverage from our side on the stock. Earlier, we were working with a target about 400, scaled it down to 365 because of the issues that the cellular service provider companies have to deal with. And of course, with Bharti, like you rightly mentioned, issues as far as facilities and the DoT. We'll have to wait and see how does that really play out from a longer term time frame. But again, Zen, which was sitting as an overweight on the balance sheet, heard the management last time when the quarterly numbers came out that they should be doing breaking even as far as Zen operation is concerned in the overseas market. Domestically, I think subscriber base is going stronger. But the turning point going forward for these companies in terms of telecom, cellular service provider companies, is going to be broadband and wireless services. That's where I believe that that's going to be a major game changer. So we still stand positive on the stock. In case, and this particular investor, he has bought it at a higher level. Stock available at about 280 or 285. So if you have investable amount, definitely go and invest over there and add more.
All right, Gaurang, thank you so much for spending time with us this week on All About Stocks. If you have questions for Gaurang, especially to do with his portfolio, feel free to write to us on the email ID at the bottom of your screen. After this break, we'll tell you if you should be participating in HUL's open offer next week and what the tax implications of your decision will be. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you so much for staying with us. Now, the big thing that we'll go through next week is the HUL open offer that will end on the 4th, that's Thursday. That gives you a few days to decide whether or not you want to tender your shares as part of that open offer. The good thing is we have Hemang Jani, the Senior Vice President of Share Fund, who joins us in the studio right now to help us understand the tax implication. Even you specifically looked at this open offer. I remember we've talked over the last couple of weeks and you said the price is really good at 600. But you do advise consumers and investors to look carefully at their own taxation. Tell us why.
See, it's important to know the tax implications in case you wish to exit the stock, because if you tender the shares at the open offer, there won't be any STT payable on it. So effectively, you will have to pay a tax of about 10 to 20%. And in case you wish to sell the shares in the cash market, in the stock exchange, then if it's a long-term holding, then there won't be any tax liability. So it would make more sense for a large number of investors to sell in the cash market as against tendering in the open offer.
So basically what you're saying is that if I were to give my shares in that open offer, I would have to pay either long-term capital gains tax or short-term capital gains tax, depending on how long I've been holding this particular stock. But if I were to just sell it in the cash market, then I won't have to pay any tax, provided I've been holding it for longer than a year. But the stock is currently at about 585, which means that I will be losing out on about 15 rupees if I sell it in the cash market. So would you recommend we forego that 15 rupees and still sell it in the cash market?
Yes, there are two aspects. One is that the cash market price today was 585 rupees. Apart from that, there is a dividend of about 6 rupees which you will be eligible to get if you hold on to shares till 12th of July. But in case you are a long-term investor and if you have purchased a stock, let's say 200 rupees, and if you tender the shares at 600, then on 400 rupees, if you have to pay 10% tax, it works out to 40 rupees. And if your tax rate is 20%, then it will be 80 rupees. So it is important to take into account this tax part before you take a decision, and in large number of cases, my belief is that it would make more sense to sell in the open market at a lesser price, and still it will make more sense for you.
Alright, so consider selling it in the open market at a lesser price, and of course take a look at your individual taxation and how that impacts your sale. We have a question that's come in on HUL for you. In fact, Arvind has written in. He has 122 shares which he bought at 572. Should he hold on to HUL? So let's talk about the third option, which is holding on to the stock for the long term. Do you believe that there will be an opportunity in the future where HUL will cross 600 and maybe give him even stronger return?
At least in the short run, given the fact that the stock has run up post this open offer announcement, we think that it might correct after the open offer is over, depending upon what is the acceptance. And we think that overall next 2 or 3 quarters are going to be challenging because we expect some slowdown in the volume growth for the FMCG companies as well. So at least in the short term, we don't expect HUL to really run up. But yes, if you have a 2 or 3 year kind of a horizon, given the fact that the floating stock would be less and there is going to be a stable growth, the premium that the company would get would be definitely better. So one can expect a good upside over the next 2 to 3 year period.
All right. And for viewers like Arvind who are maybe comfortable with the futures market, you did say there is an interesting opportunity to make money on HUL right now.
Yes, for those investors who don't want to sell their long-term holding, there is an interesting opportunity available right now whereby you can sell the shares in the cash market, which is quoting at about 585 rupees. Simultaneously, you could buy next month's future, which is quoting at about 565 rupees. The difference is about 20 rupees. We think that by doing this trade, you can pocket about 20 rupees, and after taking into account the transaction cost, effective return could be about 13 to 15 rupees. But we think that one should enter into a trade only if the gap is about 25. Current gap is too little, 20 rupees.
So wait and watch, and if you see that gap, and of course if you're comfortable with the futures market at all, then that's an interesting way to make some quick money on Unilever's open offer on HUL. Hemang, thank you so much for joining us. And of course, Hemang is a regular on the show. If you have questions for him, send them to us. There's an email ID at the bottom of your screen. We've run out of time on this show, but remember you can come back every week and we of course help you with all of your stock investments. Thanks for watching.